If utilized properly, Roth conversions can be one of the most powerful planning tools for a retiree over the course of his or her lifetime. You can save tens of thousands, hundreds of thousands, if not more, in certain circumstances when it comes to saving on taxes with Roth conversions. However, if it's done improperly, you can actually set yourself up for failure and pay more in tax than you would otherwise need to. Thankfully, today we're going to cover the basic essentials of who should be considering a Roth conversion, what a Roth conversion is, when you should be considering a Roth conversion, where to consider the Roth conversion, and lastly, why you should be considering adding a Roth conversion strategy to your retirement plan to make sure that you can save on taxes. Let's start with the basics. What is a Roth conversion? So, a Roth conversion is when you take pre tax assets or dollars that have not been subject to federal tax yet, and you convert them to Roth dollars, or in other words, after tax dollars, and you pay the tax in the corresponding year in which you complete the conversion. At the highest level, that's pretty much it. But the next question that we often get asked is who should be considering a Roth conversion? And while anyone who has a pre tax account and a Roth account can consider this, it doesn't necessarily mean that you should. The first set of folks who could stand to benefit for this are individuals or couples who expect to be in a higher tax bracket in the future than they are today. And the reason that this can make sense is when you complete the withdrawal or the conversion, you're paying the tax in today's dollars. If you're expected that your tax rates are going to be higher in the future, it may make sense to do so now. So whether that's Washington that would be changing the rates in which you could be paying, or if you're expecting your taxable income situation to rise in retirement, you could find yourself in a higher income tax bracket than you are today. So individuals who are currently in a lower tax bracket than they expect to be in the future are the first group that stand to benefit. The second group that stand to benefit are individuals who have accumulated a large pre tax balance and are expected to have required minimum distributions when they reach the required minimum distribution age of either 73 or 75. And they may not need that full required minimum distribution balance. Required minimum distributions are going to be added to taxable income. So, as a result, if you have a larger required minimum distribution, you could have a larger taxable income in that given year, which could generally mean more income tax, but could also subject you to other taxes that you may not be aware of, such as taxability of Social Security. You could also find yourself in a position where your capital gains tax could be higher. You could also find yourself having to pay the net investment tax of 3.8%. And lastly, you could find yourself subject to IRMA surcharges or Medicare premiums. So being able to make sure that you're able to keep these RMDs low could benefit you in a number of different ways. The next group that could stand to make sure that they can benefit from Roth conversions are ones who are expecting to have a longer time horizon. No way of knowing how long you're expected to live, but it's not totally inconceivable to expect that you could have a longer time horizon than most. If you have longevity within your family, and if you find yourself currently in good health, it's probably a good idea to consider planning for a longer retirement. The benefit of the Roth IRA is the tax deferred growth and the eventual tax free withdrawals that are qualified. And the longer that you're able to let your tax free accounts grow, the better situation you could find yourself in when it comes time to needing to take the withdrawal. The next set of folks who I think can really benefit from this are ones who plan to either leave their dollars to a surviving spouse or to beneficiaries. The first group could be those that are planning to leave dollars to a surviving spouse. We previously did a video on the widow's penalty. And what this ends up causing is for surviving spouses, they go from the married filing jointly brackets until the year after the passing of their spouse would then go to the single brackets. This is a problem for a number of different reasons. Number one, the ordinary income brackets and the capital gain brackets are far less favorable for single filers than they are for married filing jointly filers. But it doesn't just stop there. There are other examples where you could find yourself having to pay more in tax as a single filer versus a married filing jointly filer. Taxability of Social Security is just one example. Another example would be Medicare premium surcharges. And again, the net investment income tax is less favorable for a single filer versus a married filing jointly filer. The combination of these different things could end up leading a surviving spouse to have to pay significantly more in certain circumstances than if they were married filing jointly. But utilizing Roth conversions while both are still in favorable brackets could lead to more Roth assets, lower RMDs, and thus lower taxable income. Lastly, for individuals who are planning to leave significant dollars to heirs, it's better to leave them assets in a Roth account than it would be in a pre-tax account, specifically in the event that your heirs or beneficiaries are going to be in high income brackets themselves. The reason this is important is because there's a 10-year window in which either a Roth IRA or a traditional IRA that's inherited has to be liquidated. So, for example, If I were to receive $100,000 from my parents, my father or my mother, in a traditional asset, I have 10 years to liquidate that account. I can either take it out all in year one, I can take it all out in year 10, or I can take it spread throughout those 10 years. But if it's in a traditional account, I know that those dollars are going to be taxed as ordinary income. If they leave those dollars to me in my peak earning years, that can add to taxable income and again add to another bevy of taxes that I'd be currently paying. If those dollars are left to me in a Roth asset, and I take out a qualified withdrawal from an inherited Roth IRA, I don't have to report that as federal income. As a result, it can be far more favorable for your beneficiaries if that's what's important to you to leave them Roth assets as opposed to traditional assets. So now that we know who can benefit from a Roth conversion, I think it's a good time to talk about when you can best benefit from a Roth conversion. And as I see it, there are generally 3 times that you can best benefit and utilize a Roth conversion. The first time is when tax brackets are low. And this would include tax brackets at the federal level, but potentially, depending on how your state treats income tax, at the state level. Currently, federal tax brackets in the year 2025 are considered historically low. Now, at the end of 2025, we're going to be having the sunsetting of the Tax Cuts and Jobs Act of 2017, otherwise known as the Trump tax cuts. This did lower taxes across the board for most taxpayers. As a result, it could be a time now to consider Roth conversions without knowing what tax rates will be in the future. Now, it may be fair to say that there's going to be some level of extension of the Tax Cuts and Jobs Act, but we don't know for sure. We can't fully plan until you know what the law is going to be. If you're afraid that tax brackets are eventually going to go up, you may want to consider Roth conversions now because tax brackets going up in the future could lead to higher tax that you'd be paying. This is speculation, and there's no way fully of knowing what tax brackets will do. But historically, I think it's fair to say that we are in a lower tax environment at the federal level. We'll see what this will look like in the future. Something that you will have more control over, though, at least in certain circumstances, is when you are in a lower tax bracket. And that could be when you find yourself in things such as gap years. And what I mean when I say gap years is when some folks retire, they go from having an earned income salary at work or a high level of commissions, bonus that they could have had. There's usually less flexibility when it comes to your earned income if you're currently working. But when you retire, you can open up a number of different opportunities, such as potentially a pension, potentially Social Security election, potentially IRA withdrawals. All of these things tend to be more flexible. So you could find yourself in a position where you're actually taking a pay cut in retirement. And while it may or may not be the case that you need all that income, what you can find yourself then is utilizing the flexibility in retirement of being able to delay Social Security or delay a pension. You could find yourself having more flexibility with how much from your IRA you plan to withdraw each year. But as a result of this, if you find yourself in a lower income tax bracket, but know you'll be in a higher income tax bracket in the future, you may want to consider Roth conversions in the short term. Lastly, I think it's a good time to consider Roth conversions when the market is low. And there's no way, again, of knowing what the market will do from day to day or year to year. But what we do notice is that the market does experience periods of correction. If and when it does, rather than panicking, you should be considering Roth conversions. And the reason being is because you can consider Roth conversions as buying those Roth assets at a market low. We previously did a video where we talked about how you could have converted in the COVID 2020 year. And it would have been a great example when the S&P is down 37%. But yet at the end of the year, it's positive 10 to 12%. When that happens, if you consider utilizing a Roth conversion at the market low, any corresponding growth that you would have had that year, assuming that you would have converted at the market low, would have been tax-free inside the Roth account. As a result, rather than panicking and getting worried about market corrections, it's a good time to try to be opportunistic and to consider Roth conversions and making lemonade out of lemons. So the next question that'll get brought up inevitably is, where should I consider a Roth conversion? And I think there's 2 ways to answer this. The first way is more of a logistics question. Generally, if you're going to consider a Roth conversion, it's a good idea to convert from your pre-tax account to a Roth account at the same custodian. And what I mean by that is it's not a good idea to send money from a pre-tax account at Fidelity to a Roth account at Schwab. I'm not saying it can be done or it can't be done, but what I am saying is it can create a logistical issue to make sure that this is properly coded. It's best to make sure if you're planning to utilize a Roth conversion that you utilize it with a pre-tax account and a Roth account at the same custodian to save you and the custodian paperwork, time, energy, and just record keeping. But the second place that I would look at considering a Roth conversion is how your assets are allocated. Now, a pre-tax account and a Roth account can be invested differently. And you should also be considering your personal risk tolerance and your time horizon before utilizing a Roth conversion. One of the major benefits of the Roth is the tax-free growth and the tax-free withdrawals that you can get. As a result, the more that the account grows, the more you stand to benefit if you have time on your side. Therefore, if you're considering a Roth conversion, you may want to be considering potentially being a bit more risky and taking more of a chance for some of the growth within the Roth account. If the Roth account continues to grow, all that growth can be tax-free, assuming you take a qualified withdrawal. Again, you should be considering your own risk tolerance and your time horizon before making this move. So, in the event that you find yourself conservatively invested in your Roth account and you don't expect much market growth, that could be one less reason to consider a Roth conversion. So, now that we covered the who, the what, the when, the where, the question becomes why. And I think we've answered this for some of the video at this point. But again, why you would want to consider utilizing a Roth conversion is paying at a known rate now versus paying tax at an unknown rate in the future. Hypothetically speaking, income tax could be completely eliminated. And if you complete a Roth conversion now and there's no income tax in the future, you lost out. But in the event that you think that income tax will continue, and just my personal opinion, I think it's probably a safe bet to say that it will, we want to make sure that we have a plan in place to pay at a lower rate now than in the future. So make sure that you take an account of your own personal financial situation. But again, what you want to consider is not just income tax. It could be all the other subsequent taxes that you could have to pay as a result as well. Generally speaking, higher taxable income can be a good thing when it comes to lifestyle, but it's also not a good thing when it comes to the amount of tax that you'll have to pay. Higher taxable income or higher modified adjusted gross income can lead to additional taxes or stealth taxes that you may not be aware of. Now, if you haven't yet, be sure you check out in the description. There's a quiz that we created. It's going to allow you to answer questions that should take about 3 minutes to complete. Once you complete that, based on your tax situation, I'll send you an absolutely free 3-minute video just explaining some of the things that you should be aware of and some things on the horizon. No cost to that. You can check that out in the link in the description. But you should also consider subscribing because we talk quite a bit of tax planning and retirement on this channel. By making sure that you hit the subscribe button, you will not miss a video and you'll get plenty of insight and foresight to understand what's happening with your retirement and how taxes will continue to go. And if you haven't yet checked it out, be sure that you check out the latest on taxation of Social Security benefits, and you can find that out by clicking here.